Hey traders, welcome to our Sunday show. Great to see everyone. Great, gonna get right to what we have coming up this week. This week is a very interesting one because we go into what I personally, now I know everyone's different, but it's my show. This week, according to Raghee. So what I want to warn you all about are things that I find the most challenging every year. And I would say if there's anything where I go back on months, if not years of data, and I look at the trades that I've placed, the symbols that I've traded, the times that I've traded, the dates that I've traded, right? So, remember, gang, I know it's very popular to talk about per trade percentages or per trade returns, but we don't learn anything from that. I think you know that. What we want to do is look at a week, a month, a quarter, a year, if not years and decades. And when you start to do that, patterns emerge not only in the market, but patterns emerge in our own behavior as well. And so little things like my favorite time to trade is the morning, right? It's for day trading. Little things like Tuesday, Wednesdays, and Thursdays are my best trading days. Those patterns emerge. And then the last thing is, what is my worst trading day every year? And it's actually 4 trading days, right? And it's always end of quarter. My worst day trading days, and even really my worst swing trading days, are going to be with the outsized volatility, the outsized normal historical volatility of end of quarter, and also the third Friday of every month with options expiration. Those are 2 times that price action will exceed typical price movement range, and it becomes challenging. Now, gang, I bring this up because I know everyone wants to talk about the winners. All we do is win, like a song, like a rapper, and that's fine. But I think those of you that are here to do some serious trading know differently. We lose as traders. Of course we do, right? But what we want to remember is if we can avoid times, days, symbols, market behavior that has an outsized negative impact on our account, we've already improved our trading, right? So that's basically what I want to mention as we start this week, because it's something that I definitely want to be sure of, because it's tempting to want to keep trading. It's tempting to just do what we do. We're traders, right? I mean, a day without trading is like a dragon slayers and no dragons, right? That's how I feel. But we want to be aware. So I say this as much as anybody else. If you haven't gone back and looked at your trading, even if you're a brand new trader and it's only been a couple of months, or if you're a seasoned trader, it's been years, you will find those patterns, and immediately you will move the needle to the positive side on your trading. Okay, so with that being said, and I hope that resonates, gang, because I know talking about winning and new strategies and shiny new indicators is always a lot of fun, but it's a lot of the boring basics, right? World's most boring trader right here. It's a lot of those boring basics that move the needle for us. Okay, so next up, what are those events before end of quarter that we need to keep an eye on? Not a whole heck of a lot. We do have a CB consumer confidence, new home sales. We do have GDP, which I got to tell you straight up, I don't think the market cares one bit about, because when the Federal Reserve ignored the last time we had the negative quarter after quarter GDP and said, nope, not a recession, all of a sudden, I do believe GDP impact lost a lot of its importance, because all of a sudden the Federal Reserve redefined what a recession is. So frankly, if they don't care, why do I? But of course, Friday's GDP and unemployment claims will be a hot zone. We'll see what kind of mood it leaves the market in on Thursday. But come Friday, aside from end of quarter, the big data release says for me this week are going to be the core PCE. Now, the core PCE is the Federal Reserve's favorite. It is their pet inflation metric. That's what they use in their models to say whatever their comments are on inflation, it's based on that PCE, not the CPI. And if you ever want a good laugh, you can Google, or you can ask ChatGPT what the difference is between core PCE and CPI, and you'll see the hilarity of the number that it is that the Fed relies on for their models. But nonetheless, again, it's not about what should be, it's about what is, and that's their number. Now, another thing we've noticed the last few releases is the University of Michigan inflation expectations at 10 a.m. The last two releases have been pretty impactful. The University of Michigan consumer sentiment, it can sometimes be a bit of a near-term needle mover, but the last two inflation expectations, again, the big I word, inflation, that metric has been a big one. So CPI, PCE, and University of Michigan inflation expectations. So we've got two big inflation numbers on Friday to accompany end of quarter. All right. So that's kind of the lead up into what we've got going on this week. And again, the mindset that I keep for it, what are the best days for my trading? What are those events that tends to push historical volatility outside the norm, increases risk, lowers probability and win rates, right? Okay. So with that being said, as always, this show is about your questions. Feel free to type them on in. My lighting colors are weird today. Let's take a look here. No, that's a little bit better. Okay. Oh, the other way was nice. It looked like I had a nice tan, which I did not get this week. A lot of rainy weather here in South Florida. All right. Hope everyone had a good weekend and some nice relaxing time before we get right back to it on what should be a very volatile week, or at least end of the week. All right. Next up, Gone to Earth asks, do I acknowledge the VIX at all before a trade? Gone to Earth? No, not really. And there's now, mind you, everyone's got different tools. So I don't want anyone thinking, well, it's not important. I like looking at VIX from the standpoint that it is a futures contract, right? The CBOE Volatility Futures Index. One of the reasons, and it's not VIX alone, Gone to Earth. I don't actually give a lot of merit to most market internals because they are not weighted like the indices that they're designed to reflect, or the indices that we trade. Case in point, the indices are high concentration weighted. A very few number of sectors and a very few number of stocks weight what happens in the index. And yet, most market internals that I'm aware of are not high concentration weighted. So we're not seeing a disproportionate representation of certain stocks and sectors in these market internals. So we're measuring, for example, with the case of ticks or advanced decliners, it does matter who's ticking up, because certain stocks are going to have a bigger impact on the indices. It does matter which stocks are advancing versus declining, because once again, certain stocks have far more weighting than others. And so for that reason, the VIX would fall into the same category. Another reason I'm not a big fan of the VIX right now are zero-dated options. This is a 30-day VIX. There is a new one-day VIX contract, and I think that that's something that could be interesting. Remember, it's a 30-day volatility index. And I do find, because of 0 days to expiration options, their popularity, this takes, as well as put call ratio, by the way, has lost a lot of any real insight into market behavior that it may have had before. My opinion, my 2 cents, but typically no. Gone to Earth, if I want to buy the NASDAQ, let me give you another example. So you might think, okay, Rod, what do you use? Okay, let's say I want to buy the S&P. I want to buy the S&P, or I'm interested in the S&P. The structure on the S&P would supersede anything else, right? So it's not the VIX or the put call or advanced decline or ticks or trend or whatnot that's going to tell me what I want to do with the S&P. It's primarily the S&P. So imagine the S&P as a car. We lift the hood on the S&P. We look at the motor. What's the motor? It's this, XLK. It's this, XLF. And it's XLV. So at the sector level, there's sort of 3 cylinders, if you will, to run with this engine under the hood analogy. These 3 main sectors, they're the heaviest weighted sectors. If I want to dig a little bit differently and deeper, I can start going into the top weighted stocks. So I'm going to have a much better idea of where the S&P is going based upon the pieces that actually make up the index. And that's the way that I look at it. So I hope that makes sense. So, I could have just said no and moved on, but what do I do instead? And I hope that is something that makes sense. All right. I hope that's something to say, well, Rog, I may not agree, which is cool, right? We all have different opinions about the market. I've been reading a new book this week. I just got this one. I don't know if you can see that. Chaos Kings. It's pretty interesting, right? It's really interesting breakdowns of different market outlooks, and it's actually a really good read. I'm about three quarters of the way through it. It's actually a really cool read, and it just reminds me there's so many ways to navigate the market. So to say that this is the way is just not only incorrect, it's arrogant, right? It's just my way. And I think that's the only thing any of us on this side of the camera, this side of the mic can say. This is what I do, right? This is what I do. So hope that helps. All right, moving on. Patrick asks, what is the software you use to track your trades? Yeah, Patrick, I have to give a lot of credit to one of our members who turned me onto this piece of software, I think mid-year last year, maybe early last year. And the Lorna bot, who many of you know, she is one of the traders in any room that I'm in the Sector Secrets Mastery, etc. And Lorna and I have been testing the Trades Viz, TradsViz. Here we go. This Trades Viz. Can y'all see that? I know it's a really small logo. There we go. Trades Viz. Actually been in contact with the owner of Trades Viz too. I'm a big fan of this. It's one of the least expensive of the different services out there, which I appreciate. And it's probably one of the coolest. I really, really like it. One of the other reasons I like it is because it works very well in tandem with a company called Tradier. I'm just testing it out because TradesViz and Tradier seem to have some sort of cooperative agreement where they work together really well. Where any trade that I put on, yeah, my Lorna says you're showing your username. They know it's that one's it's okay. It's all good. Everyone knows everything is Raghee Horner, right? Yeah, I know. All right. So anyway, Lorna Bach saying, turn on the two-factor authentication. I know. My Instagram, my Twitter, I lost my Twitter for 2 weeks this year when someone else hacked my Twitter. I know, bot. Well, luckily, that's not the one that's attached to my account. So we're good. Anyway, back to our show. I use TradesViz. Yeah, I'm a big fan of that. It has actually they started doing some AI stuff with it. So they've worked in some AI, and you can ask the AI within TradesViz about certain facets of your trading habits and so forth. It's very cool. And that's what I'll be using going into the remainder of this year. And I mentioned that because come July, we're going to start a couple of test accounts that we're going to make open to members that we're going to use TradesViz for not just per trade transparency, but overall account transparency, which I'm far more. You're giving me the face. You give me the face palm now. Yes, I will change my username as soon as the show is over. Bot's giving me all sorts. Ah, there we go. I think I kicked myself out of my own show. Let's get it. Let's get it back. All right. Here we go. All right. I'm back. I'm back. Yeah, the video just hiccuped. All right. So that's the software that I use. Yeah, that's the software that I use, Patrick. And I'm a big fan of that for sure. Yeah, tradesviz.com. Yeah. All right. What are the two economic releases that I'm looking at? CPI and the University of Michigan inflation expectations. Those are the two. Isaac? Yeah. Isaac, that's what we're looking at. So there is a GDP release. Of course, it's end of quarter, but CPI and the University of Michigan inflation expectations, which is another lesser known part of the University of Michigan Consumer Sentiment Report. Yes. All right. Praveen asks, good evening. Yes, good evening. We take a look at NASDAQ and ES. I believe due to sector rotation, perhaps YM will be going up. All right, let's stick with this sector conversation, right? That's a great point, Praveen. Let's stick with this sector conversation. So if the Dow is going to go up, right? Looking at the NASDAQ, looking at the S&P, these are the two relative outperformers. And why? Why are these the two relative outperformers? Because the sectors within them are, as we mentioned, outperforming. So if I head on over to, hang on here. Here we go. If I head on over to, I love this service, Koifin. All right. So I head on over to Koifin and I take a look at the US sectors. And I'm looking at rotation. Now, remember, again, rotation is one of those things, it's a word that gets thrown around a lot, but what does it mean? For me, it means specifically that outperforming, let's look at it this way, profitable sectors start to see profit taking, right? Because institutions don't want to buy at higher highs. Retail traders do that kind of stuff, to be quite frank. So what happens is, let's say we start to see profit taking in XLK, XLY, and XLC. Those three sectors at the very top. That's the NASDAQ, gang. Those are the three sectors of the NASDAQ. At the very bottom, you've got XLE, XLU, and XLRE. So if I'm looking at just sort of a textbook example, not that sector rotation is always going to be textbook, but if I look at a textbook example of sector rotation, profit taking in the three main sectors of the NASDAQ would benefit real estate, utilities, and energy. Now, it's not that it could not benefit basic materials or staples either. But, if I'm looking at the very most profitable sectors, seeing profit taking, and then bargain hunting, this is the way we would look at it. Now, do those three sectors benefit the Dow? The truth of the matter is no, right? So if the Dow is going to benefit from sector rotation, it's going to need, frankly, XLF, financials, and XLV. If XLF and XLV, and by the way, Praveen, I do think if there's going to be a little bit of bargain hunting in sectors, not necessarily rotation, which is different. We can have buying of certain underperforming sectors, but it doesn't have to be part of rotation. Again, rotation is most commonly out of one sector and into another, hence the rotation. We can have cash just simply coming off the sidelines saying, you know what, financials are due. Healthcare is due. Now, if we see strength in financials, that Praveen, XLF for sure, is going to benefit the Dow disproportionately, because what I find interesting is a lot of traders don't realize that the Dow is not really IYT and XLI. Not really. It's XLF. That's the number one weighted sector in the Dow. It might as well be called the Dow Financials average. It's not really the Dow Industrials average. And Charles Dow's out there somewhere face palming himself thinking, what has happened to my beloved average? It's become a financials, tech, and healthcare composite. So if that's the case, keep an eye on that sector, Praveen. That's the way we want to look at it. All right. John asks, how do I set up Tesla for end of quarter inventory announcement and 5 weeks before the quarterly event? So those events are reason for attention and volatility, right? So the first thing we want to do is sort of keep the events and the attention grabbers on the sideline for a moment and ask ourselves, all right, what is it that we are looking at in Tesla? Is it an uptrend? Absolutely, right? It's fairly fresh, but Tesla's got the memo. It's north of the 200 exponential moving average. It's making new highs on the year. It has been consistently since the beginning of June, and it's organized into an uptrend. It's had a heck of a catch up, right? So now we want to ask ourselves, what's it going to take for some kind of buying opportunity to set up? So the catalysts are not going to give us a price, right? The catalysts are going to give us reasons for certain prices to be met, and I would need certain prices to be met to the downside. The point of control is pretty much in line with the 200 exponential, which is the most volume that's occurred in 2023 is sitting at about 196. I don't know that we're going to see that level. That would be great. I'd be more than happy to buy at that level, John, but I don't know that we're going to see it. So the next thing I can do is I could start to pull different tools. I can look for a retracement. Or I can start to ask myself, all right, well, if I was going to make a retracement, what would a retracement look like? Right? What would a retracement look like? 50% retracement, a golden mean retracement. That might put me between 228 and 216 and a half. Right? So I could start looking at that. I could start looking at other volume ledges. I can look at other levels this year that are important. The other thing I can do is just look at the quarter, right? I could look at April, May, and June. I could anchor my volume profile to basically April and ask myself, where might there be any volume ledges? And you want to see something really interesting. Right here, you can actually see it pretty clearly. There's a slight volume ledge right in here, accompanying the 50%, and a slight volume ledge right in there, accompanying the 618. I think that's kind of interesting. There's two volume ledges there accompanying both those retracements for the last major move. They're not significant. They're not the tallest. But when I think about where there's a little bit of volume accumulated, interestingly enough, stacked at the 50% retracement, stacked at the 618 retracement. Pretty interesting from the last major move. And that's the way that I'll look at Tesla. Those would be two very interesting levels. Another level that's probably less subjective, because let's face it, Fibonacci is terribly subjective, powerful, but very subjective. You hand a chart on over to 10 Fibonacci practitioners, they're going to look at it 10 different ways. Remember, again, Fibonacci is not a trading tool. It's a mathematical law of expansion and contraction. So to say there's one way to do Fibonacci is ridiculous. It's not even a trading tool where we would say, hey, this is the trading application. No, we think about expansion and contraction. We do our best to find those ebbs and flows and then look for those retracements within that. So again, opinions will vary on the application of this mathematical law of nature. That said, what's a little bit more objective a level? How about a gap close? How about we had a gap from June 8 to June 9, and the gap close would occur at 234.86. How about a level like that? That's also pretty interesting to me as well, and it accompanies that 50% area pretty well. And there's a little bit of a volume ledge there. I'm a little surprised we don't see more volume there, but that might require anchoring our volume profile to June and asking ourselves, all right, if we were to look at that level, but yeah, even then, it's actually more of the volume occurred at where we opened after the gap. You see that? There's a little bit of a volume ledge for June at about 247.25. So that's a little bit more in line with where after the gap up occurred, boom, there's a lot of attention there. There's a price-based volume ledge, more activity, more trading, more attention, right? More conviction, more participation at that level. So the gap close is interesting, but maybe just revisiting the gap open or gap area could be also quite interesting. And that's another level that's showing up right in there, right around 237 or 247 and change. So that's the way I'd break that down, John. So all those events are interesting. And then we say, okay, that could give us volatility to the upside, the downside, but where would we have price levels that we can act from? And it doesn't matter that I broke down Tesla. It could be any stock. I'd break it down in the same way. Where are the gaps? Where's the volume? What's the trend? Where are retracements, right? These are all really basic things we can do. And if those different tools start to overlap at certain levels, fantastic, right? Okay, cool. All right, Guillermo asks, what are the LHPMRs and how do they differ from the HPMRs? Are they available in TradingView? So the LHPMR is just the least of the HPMR reading. So what that means is, so HPMR's hourly price movement range is a tool that I developed well over a decade ago. It's a process that shows you what hourly volatility is, right? Every hour, there's a certain amount of volatility, and there is a high, there is an average, and there is a low. All right, there's a high, there's an average, there's a low. So when I talk about an LHPMR, I'm talking about the low or the least amount of price movement range. And yes, they're available in TradingView and Thinkorswim. Yes. All right. So the least. So again, anytime we're looking at hourly price movement ranges, daily price movement ranges, these processes that I created, like I said, a decade ago, and then we just plot those zones on the chart. There's a high, there's an average, and there's an L or least or low, right? And that's what the LHPMR is. So it's part of the whole thing. Yeah, it's part of the whole thing. All right, next up is, let's see here, George S. I remember I bought up the potential double top on NDX. I remember I bought, an NDX last week. Okay. bought up at the I'll let me bring it up. I don't trade NDX, but and I'm trying to remember, George. I a lot has happened between now and then. So I bought the. Did you have a question, George? I'm happy to answer. I'm not quite sure of the question. If you're long, I mean, that's a better, I would think if you're long in the NAS, that's a better place to be. NASDAQ, QQQ, NASDAQ futures, XLK, XLC, XLY. Yeah, I'd be a fan of the long side. Yeah, for sure. For sure. Is there a minor high on Tesla on the daily? There very well may be, John, but I'm not going to look for minor high short setups in an uptrend. So it's not unusual to see on the path higher that we're going to have both minor highs and minor lows. That's not unusual at all. So ultimately, what I want to do is think about, well, if the minor high is a precursor to a pullback, then great. Maybe it's a gap close, maybe it's a volume ledge, maybe it's the gap open that we saw Friday on the 9th. Whatever it is, that might be sort of what's going to trigger that move to the downside. But again, I won't short it. Was there one? Yeah, you could say. I mean, it was a pretty big pattern, really not a pretty looking one, but for all intents and purposes, it was a higher high surrounded by two lower highs. So yes, yes. All right. So, and by the way, if we're looking at Tesla in terms of the movement, right? And whether we're looking at the NASDAQ or the NDX or the QQQ, what have you, um, whatever it is, remember that movement lower on Tesla is also likely going to be accompanied by movement lower on XLY because Tesla is the number 2 weighted stock in this particular sector, right? So if I want to see XLY move lower, that would be Amazon, that would be Tesla, that would be Home Depot. Yeah, so those would all be worth keeping an eye on, that XLY in any of the sectors, right? Always remember what the top 2, 3 stocks are in each one of them. All right, any thoughts on BLX? Close above the VWAP on the weekly for the third time. I mean, it's in an uptrend, Damien, on the daily time frame. It's in a really nice uptrend. It just formed an uptrend on the weekly. So, I mean, this is buy the dip valid on the daily, right? So whether you want to look for retracements, whether you want to look for volume ledges, you could throw the 34 EMA wave on there. Yeah, so whatever it is, however you find what a dip is within the context of an overall uptrend, Damien, this is the environment that I would apply that strategy in because strategy, right? Structure dictates strategy. The strategy is going to be determined by what the overall behavior of that stock or sector or futures contract is. Good stuff. All right, gang, as always, thank you so much for being here for our show on Sunday, preparing for next week. Keep in mind what I mentioned. How are you grading yourself? Every day? Don't do it. Once a week, once a month. Absolutely. I'm using TradesViz. We're gonna go beyond what is really just not a great practice, which is how much percent did I make per trade? Who cares? Is it adding to the overall account growth? Can we talk about scalability of an account? And we'll be getting into that topic a lot more, both Lorna Bot and I, come July. We're really excited for this summer, flipping to a little bit more use of TradesViz and Tradier and showing you what we have been working on. All right, gang. I'll see you tomorrow for Charts and Coffee. Be good to each other.